Okay, Matt, let's go back to Twitter for one more question this week. And this was one we got over the break from @Chris_M_Jones. And Chris asks, would love to have your take on portfolio allocation. I received my annual portfolio review from my broker and went through it. I had never really thought a lot about sector allocation, but wanted to get your take on the importance or lack thereof on sector allocation. My portfolio is 52% tech, in quotation marks. I'm a computer programmer scientist, so I try to invest in what I know best. And I'm also overweight in consumer cyclical and basic materials and underweight all other sectors based on comparing to the S&P 500. Thanks in advance for your insight. Okay, so Matt, this is a big, wide-ranging topic, portfolio diversification and allocation. And I thought it'd be a neat opportunity, at least for us to talk a little bit about it and give Chris maybe some ideas. What do you think there when Chris tells us about his situation?
Well, I don't think he's doing anything wrong, really. To tell you, like I just mentioned Peter Lynch's book, One Up on Wall Street, and the whole kind of underlying theme of it is invest in what you know. And just kind of right before we recorded, I tallied up some of the numbers from my own portfolio, and this actually kind of surprised me it was this high. But my portfolio is 56% split between real estate investment trusts, the REITs, insurance companies, and banks. The three things I know the best make up well over half of my portfolio. And tech is kind of right up there, too. I'm overweight tech and very underweight things like healthcare, which I know nothing about. Underweight in a lot of industrials, which I don't understand that well. So I wouldn't know enough to make good investments in those areas. If anything, I would probably buy an index fund that invested in healthcare stocks.
Yep.
Just because I don't really know. Having said that, there's a limit to the invest in what you know thing. Like I said, there's a reason I don't have 100% of my portfolio in REITs, although I feel that that's probably one of the best long-term opportunities right now. You still want to kind of find the best of the best in the other sectors. If you don't know a sector that well, it's a really good kind of strategy to either A, buy an index fund like I just mentioned, or B, find the best of the best players in that industry with big competitive advantages, that aren't going anywhere. Just to kind of give you an example, I'm not a tech wizard or anything like that, but I know enough that Apple's a great company, which is why Apple is very overweight in my portfolio right now. So that's kind of my advice. If you do feel you need a little bit of diversification into sectors you're not too familiar with, if you need to get into banking, for example, either the XLF, that index fund I mentioned a few weeks ago, or one of the big banks like a JP Morgan Chase, you really can't go wrong with one of those. So again, invest in what you know. I wouldn't really dive into like any smaller mid-cap stocks in an area that you don't really know very well. But as far as the best players in the sector or index funds, that's kind of the way to go, in my opinion, if you're not too familiar with the sector and need a little more diversification in your portfolio.
Yeah. And I was reading this question, and the first thing that came to mind was Warren Buffett's quote regarding diversification, right? He says diversification is protection against ignorance. It makes little sense if you know what you're doing. I think there's something to this, and I guess the first thing that I think is really don't diversify just for the sake of saying that you're diversified. If you're investing in something that you have no idea about, that's not diversification. That's just bad investing. So if you don't know anything about, materials or cyclicals or whatever it may be, energy, healthcare, don't just assume that you have to have that exposure because it makes for good diversification. And to your point, having a fund probably makes more sense in those areas where you're not so familiar with the actual space. And I also wanted to go back to one thing in 2018. Remember that there was these S&P communications sector. The communication services sector was launched. Essentially, the S&P made this new sector because I think everybody at this point probably feels like they're overexposed to tech. And that is because most of the things in our lives all revolve around tech in one way or another. But the S&P put together this S&P Communications Services sector. And this sector ultimately included companies from 3 different industry groups in telecommunications and technology, and then also consumer discretionary. But the basic idea was that we are in such a tech-driven world today that a lot of these companies are viewed a little bit differently today than they were perhaps 10 or 20 years ago. So main point here is if you feel like you're overweight tech, well, that makes a little sense because we are in such a tech-driven world today. So I don't think that's really ultimately a bad thing. And then just to take a little bit of a bigger picture view, less about markets or sectors and focusing more on small cap, large cap, mid cap, things like that. I went to our premium pass offering here at the Fool to look through some of the portfolio tools that they have. And they have some recommended allocations there for folks who are either in that grow your wealth phase or defend your wealth phase. And just to give some numbers there, in the grow your wealth phase, the recommendations in premium pass, and these are of course workable. I mean, nothing's set in stone, but they're saying if you're looking to grow your wealth, have 25% of your portfolio in large caps, 15% in mid caps, 15% in small caps, 30% in international, which I found was interesting, 10% in alternatives, which could be real estate or REITs, like you were talking about there earlier, Matt, and 5% in bonds. But generally speaking, the idea is there with that grow your wealth portfolio, you can take on a little bit more risk at that point, and that's why you have such heavy exposure to stocks. If you go to the defend your wealth portfolio there, they have large cap at 25%, mid cap at 10%, small cap at 10%, international now at 10%, alternative at 5%, and bonds at 40%. And I think those are things just to keep in mind because every investor is a little bit different in their goals and their stage of life. And so if you're older and you need to focus on protecting your wealth, you need to allocate a little bit differently and make sure that you are taking some of that risk off the table. But again, a topic we could probably go on for hours just talking about diversification and allocation. But Chris, we hope that helps out with your questions there.